Hey everybody, welcome to this week's episode. Finances can be intimidating. I get it, especially with all the jargon and vocabulary words that are used out there today. And we're just supposed to be expected to make these big, lifelong decisions without really even knowing the words on the page or the characters in the financial play. But in our episode today, I want to spend some time talking about one of those vocabulary words, one of those opaque words called dividends. And I'm going to be clearing the air on how they work, what dividends allow you to do in terms of regaining certainty, control, and safety in the midst of a very uncertain world. So it's been a rough year so far, as of this recording, for the stock markets. Lots of choppy waters. In fact, as this is being recorded, the Dow has seen terrible drops as well as tremendous gains, beating out almost every other market in recent history in terms of volatility. Now, during challenging economic times, I know many people are reminded of the potential for losing value and the actual reality of losing value in their portfolio. I've had more people than I can count reach out to me this spring 2025 looking to increase their financial protection, interested in learning more about the benefits of guarantees, of dividend paying whole life insurance as well. And in today's episode, I want to dive deeper into that part, the dividends part. What are they? How are they determined? What options do you have when you receive dividends, and which companies are offering the most dependable dividends? So let's go ahead and jump on in. And I'm going to kind of lay this out in the form of a sort of a Q&A style. So the first question that I hear a lot is, Mark, what is a dividend? Well, it depends on what type of dividend we're talking about. First of all, when you're looking at dividends on stocks, they are a payment made by a corporation to its shareholders. So typically, it's a share of profits paid off in cash or sometimes in additional shares in stock. And this dividend is determined by the board of directors, and dividends represent corporate earnings and are usually taxable as income. So dividends on stocks are not guaranteed. Okay, in fact, recent trends, even among the blue chip stocks, those are kind of your stalwarts, the ones that are always kicking out profits. Even the blue chip stocks are showing dividend cuts. For example, AT&T reducing its payout by 50% in 2022 after spinning off Warner Media, and also Verizon trimming its dividend in 2023 among economic pressure and market changes. Now, many millions of retirees are relying on dividend-paying stocks to provide steady income for them in retirement. So when they see these major changes among dividend-paying standard-bearer stocks like this, it means real cuts to their income, and done in a time in their life when they are the most vulnerable in retirement, when they don't have an earned income to replace those dividend cuts. Now, in contrast to stock dividends, a dividend on a participating whole life insurance policy is different. It's known as a return of excess premium paid to policyholders, and it's only paid out by mutually owned life insurance companies. So this is reflecting their performance, the company's performance. This might mean investment returns, or maybe lower than expected death benefit claims were paid out in the previous year. So when a premium is calculated, there is some built-in margin over the anticipated costs of insuring my life, your life, or whatever. So this margin is designed to cover, fluctuating factors, maybe higher than expected mortality, or, something like a pandemic, for example. It'll also factor in the office expenses and staff expenses of the insurance company. It also factors in the return on their general account. They put the money to work in things like real estate and bonds and that sort of thing. And when they factor all this in and their multiple factors are better than they anticipate, a portion of that premium paid may be refunded back to the owner, and this is a returned premium, aka a dividend. Now, policy dividends are the result of the performance of that eligible policy. Only dividend-paying whole life insurance gets a dividend. You might have a term insurance policy or a universal life policy at XYZ Insurance, but you're not getting that dividend unless you are a owner of the company, i.e. a dividend-paying whole life insurance policy holder. Okay, so it's super important that you are a owner of the insurance company and not just their asset. Which one would you rather be, an owner or an asset? So this is all going to be incorporated into the investment returns, the taxes, the policies that are currently in force, claims experience, mortality and expenses. All of this is baked in, and the dividend scale is always, again, made by the board of directors. And similar to stock dividends, but I've also referred to whole life dividends as a return of premium. And so this is different than maybe you might expect. Dividends are generally seen as profit, but when whole life insurance is involved, it's a return of premium. Now, Dave Ramsey and other financial infotainers sort of poo-poo this, and they say, oh, it's just a return of premium. What kind of profit is that? Well, here's the thing. Because of its classification as a return of premium, dividends are not considered taxable. Okay? They're not considered taxable unless you withdraw them and they exceed the total cost basis, all of the premium you paid in. This is actually one of the best parts of viewing a dividend as a return of premium. You're avoiding a lot of the capital gains taxes that come with stock dividends, for example. This is one of the best ways to view a dividend in the financial universe. So I'm not sure what Dave Ramsey thinks when he says it's just a return of premium. I'll take it. Thank you, especially because I can get those gains back out tax-free. So next question, what's the difference? A lot of people ask me, what's the difference between the dividends and you, Mark, you talk about this thing growing guaranteed. Well, what's the difference between dividends and what's known as the non-forfeiture guaranteed interest rate in my contract? The contractual guaranteed non-forfeiture interest rate is the rate used in the calculation of your cash value, the guaranteed cash value accumulation. It is not, I repeat, it's not the rate used in calculating dividends. So I want you to think of cupcakes with icing, okay? So the non-forfeiture interest rate is the cake. It's the guaranteed increase of your cash value every single year for the rest of your life. So hear that very clearly. That is the cake on this metaphor. The dividends are the icing on the cake. Dividends are not guaranteed, but are an extra helping. They're an extra treat on top of the guaranteed cash increase. And just as a side note, the companies I work with have consecutively put icing on their cupcakes for 100 years or longer without fail. So that is quite a track record of icing. Next question, what is the most important thing about dividends? Okay, here's the fun fact. The most important thing about a dividend is what's underneath. It's the guarantees. Again, some companies misunderstand this, or they view dividends as some sort of a marketing ploy rather than what they should be, which is a reward to the policyholder for sticking with them for the long term. So here's an example. Let's say you're faced with two insurance companies and you're trying to pick which one is better. Company A has a 1% dividend and Company B has a 4% dividend. Which one sounds better to you right now, just on its face? Well, clearly Company B with its 4% dividend sounds like it's doing much better, right? Right? Sounds to me like it. But remember what I said about cake and icing. There's both guarantees and dividends baked into every dividend-paying whole life insurance cake. Now, what if in both of these companies' circumstances the total was 5%? Would that change your picture of which one was better? What would you rather have? A company where a dividend of 1% and a higher guarantee of, let's say, 4%, or Company B, which had a 4% dividend and only a 1% guarantee? Both companies, total cake and icing was 5%, but which company now seems more dependable to you? That's right, Company A sounds better because I'd rather have a 4% guarantee and a 1% non-guaranteed dividend. Remember, dividends are not guaranteed, but the guaranteed increase of the cash value, that non-forfeiture rate, is. And the dividend depends on the insurance company's performance, investment returns, expenses. All of those things can change. Whereas the guaranteed increase of your cash is baked right into your cake. It's right into the contract. It cannot be changed. The guarantees in your contract are what ensure that your policy will perform even if dividends falter, which offers you much more predictability for long-term planning. Now, guys, here's an industry secret. Insurance companies don't want you to know about this. It's true that contractually speaking, an insurance company cannot change the guaranteed increase of the cash value once your policy is issued. Okay, so once you've bought your policy, it's issued and set up and you're paying premiums, that guarantee is locked in for life. However, many insurance companies out there make new decisions all the time on possibly lowering their guaranteed rate on new policies so as to inflate their dividend and make them look more sexy, more interesting, more profitable. So they can sell this new version of the product out there with a lower guarantee and a higher dividend. Think of it like shrinkflation for your whole life insurance. You remember shrinkflation, right? Where they would shrink the size of the potato chip bag. This happens with whole life insurance by lowering the guarantees on new policies. Again, they can't change one once it's locked in. But on a new policy, they can decide to sell that new whole life policy with a lower guarantee, higher dividends. Again, shrink the cake, increase the icing, which may or may not always be there. Now, I often see insurance companies flaunting these big, juicy icing-related dividends, but hiding the fact that they've lowered those guarantees. Again, the shrinkflation is hard at work here with contracts going forward. And I also see consumers, the buying public, getting confused about dividend rates and guarantees, which leads me to my next question, which is, what is the most frustrating thing about dividends? Now, there's nothing much frustrating about them. It's wonderful to receive them. But I guess you might say the most frustrating part of understanding dividends is that there is literally no uniform industry standard for calculating the dividend rate. So while subject to many of the same factors of market pressures and more, insurance companies will calculate and report dividend scales quite differently. Okay, so the dividend rate at company X is going to maybe be very different than the dividend rate at company Y. They might have different formulas for calculating their dividends. So is it really even a meaningful metric to compare two insurance companies off the dividend rate? No, it's really not. As a financial planner, I often caution people about the red herring of insurance companies that obscure whole life policies' true performance through dividend manipulation. Again, one common tactic is emphasizing a high dividend rate without context. For example, insurers can manipulate dividends by just investing in shorter-term bonds or temporarily boosting the yields with riskier assets, or using short-term accounting tricks to inflate their dividend profits in the current year. Now, some highlight projected dividends that aren't even guaranteed but create this illusion of superior performance. And other insurance companies focus on marketing tactics, touting one-time bonuses or rider benefits, distracting from the policy's core guarantees and value. These distractions make it, I think, harder to compare the policies fairly and mislead the buyer into prioritizing short-term gains over long-term reliability. The real test of a good insurance company lies in the stability, the dependability of its dividend rate over time. In fact, an insurance company that consistently pays steady dividends even during economic downturns demonstrates real financial strength, and that's the kind of company that you can count on. So in particular, this is where the concept of dividends standard deviation comes in plain English. What does that mean? Again, it measures the dividend rate fluctuation over a long period of time, let's say 20 or 30 years. If a dividend rate is jumping around a lot, up at 6% this year, down to 3% next year, then up at 8%, that is a fluctuating high standard deviation between results, right? Lots of different options to pick from. It'll signal a lot of instability. But if it hovers at, let's say, 5% with only a few small changes, that's a low standard deviation, and it shows the insurance company's reliability. So when you're evaluating insurance companies, it's really important to look at the dividend's history, not this year's dividend, but the history of dividends over a long period of time. Again, a low standard deviation, meaning over, let's say, a decade or 2 decades, that's going to indicate that the company can weather market volatility. It can maintain its profitability margins. It's not throwing money into high-risk investments. It's going to ensure that your policy is going to do what it said it would do when you bought the policy in the first place. And in fact, I'm going to include in the show notes a really important chart that goes through 8 different insurance companies from their dividends from 2019 to 2025. And we're going to look at the change in the dividends between that period of time. What was the volatility of the dividends? And I want to walk through a few of those now, but if you want to see the chart, do check out our video on YouTube or our show notes. Now, for those of you who can see the show notes, or if you're watching the video, take a look at the chart. Again, from 2019 to 2025, you're looking at 8 different whole life insurance companies and their dividend rates over the last 6+ years. Now, I did remove all the company names to help you focus on the concept here, but if you want more detail about each of these companies, please reach out to me and my team at nyafinancialpodcast.com. Click on Request a Meeting, and not only will we look at this chart in detail, but I'd be happy to review any policies you've come across or that you currently own as well. So again, that's nyafinancialpodcast.com, and click on Request a Meeting. Now notice company 1 in our chart. It started 2019 with a 5.1% dividend rate. Not bad, but not the highest on the chart in that year either. And the highest dividend rate in that year was at 6.4%. And also notice company 8 was at 5.4%. In fact, almost every other company on the chart in 2019 had a higher dividend rate than company number 1. So if you're buying a policy in 2019, it would appear that the weakest company is company 1 with 5.1% dividend rates, right? That's the lowest one on the chart in 2019. If you're living in 2019, what can you not see? That's right, you cannot see the future. What happened in 2020? Well, among other things, a global worldwide pandemic which negatively impacted life expectancy for millions of people. To say that another way, many people died that would not have otherwise died, at least not that soon anyway. Now, if there was ever going to be a financial crisis for the life insurance industry, and including these 8 companies, you'd think a global pandemic, which shortens life expectancy, would draw the tide out to show which insurance companies were swimming naked, so to speak. So let's take a look at the chart and just see which companies performed best in the prevailing years and which ones had true financial strength and which one was just skinny dipping. Now, company number 1, remember the dividend rate was lower in 2019. Not only did it hold steady in 2020 and even through 2023, but the dividend rate increased in 2024 and increased again in 2025 for a very strong plus 65 basis points over that period of time. That's the strongest performance of all 8 companies. Now, to me, this proves a very important fact that company 1, again, while having a low dividend rate in 2019, had the strongest financial balance sheet of all 8 companies. And underlying that dividend rate was a guarantee, a promise that the policies would continue to perform well, regardless of market or even pandemic conditions. Scoot down to company number 6 with its super high 6.4% dividend rate in 2019. Unfortunately, after that year, dividends began to drop, and in fact, they dropped 40 basis points all throughout the pandemic. And now, only now, as interest rates have risen, have we begun to see them claw their way back up to where they were in 2019. In other words, the only way they found their way out of the terrible mess of the pandemic was the high inflation that came as a result of massive spending post-pandemic. Now, to me, as a financial planner, this is not a reassuring sign to offer this type of a company to clients. And what about company number 8, which, again, had a very respectable 5.4% in 2019? Well, they dropped dramatically from 5.4% down to a measly 4.0%. This is the worst one on the chart. That's like losing 25% of your profitability in just 3 years. Remember, this is supposed to be a boring asset here, okay? And they've remained at 4.0% ever since. In fact, I know this company is still very much promoted by many people who uses phrases like infinite and banking and cash flow banking and other similar knockoff brands. Not only is this company in a free fall with their dividend rate, but they also closed their doors to new policies being applied for or issued during the earliest days of the global pandemic in 2020, saying they would not take any new applications. No other company that I do business with made any overtures like that in 2020. To me, that exposed their weak balance sheet, this particular company that shall not be named publicly on this podcast. And it reminded me in 2020 why I choose not to do business with this particular company, even though they had a, quote, higher dividend rate than one of my favorite companies, which is company number one back in 2019. By the way, I did a whole expose on some of the problems of Company 8, and some of the problems specifically they have with policy loans back in episode 401, and further even still back in episode 385, because this particular company is a direct recognition company when it comes to taking policy loans. So go back and check those 2 episodes out if you want to hear more. Now, insurance companies love to announce their most recent dividend rate. They declare it like Moses coming down from the mountain. And life insurance illustration software, this is a big deal, it calculates the dividend in a way that personally I think is very misleading. They'll take this 1 year's dividend rate and they'll repeat it every single year for the rest of your life. Now, do you think that's a reasonable way to project performance into the future? It sure can be if the insurance company's dividend is dependable, if it has a low standard deviation or variance. But it can be very misleading if the insurance company pumps up their dividend for a single year to get great looking numbers on their illustration software. Think of that. If they could just pump up their dividends this year, then all of their software pumps out charts and illustrations to make it look like that dividend will repeat itself every year for the rest of your life. And if you happen to be tricked into buying a policy that particular year, you'll be disappointed the rest of your life. I kind of think about this sort of like if I took the batting performance of all the MLB players from last week's game and repeated that batting performance for the rest of their careers. Is that likely? Is it likely they're going to repeat last week's performance for every single week for the rest of their baseball career? Of course not. There's going to be variations, just like there will be with insurance company dividends, and yet the softwares of every insurance company out there, in fact, regulations require that the software does not allow us to show for variation of dividends. In short, this year's declared dividend rates are a red herring. What you want to see is the steady performance and low variability or standard deviation of dividends over a long period of time. Okay, I'm off my soapbox. Let's jump to the next question. This is a little more fun question, a little more optimistic question. Mark, what can I do with my dividends? Now, since you're a co-owner of the insurance company, again, when you're a policy holder, you're in essence an owner in the company. The truth is you keep your profits. When you receive a profit, they call that a dividend. Again, a return of excess premium is paid out as a dividend on your whole life policy. You have a number of options. Remember, this is your money. It's your cash. You can do what you want to do with the money. Now, my favorite option for most of my clients is to use the dividend to purchase paid up additions. So under this option, any annual dividend is applied as a single premium to purchase specific paid up additions insurance at your current age each year. So each year you get a dividend, you just basically drop it right back into your policy, purchasing more paid up additional insurance, which only accelerates how much cash value you have. It also inflates and grows your death benefit as well at a faster and faster clip. Now, this is just one of a number of other options also available to you. For example, you can use your dividends to pay part or all of your annual premium. Now, if the dividend is less than your premium, you're still going to be billed for the difference. So if, let's say, your premium is 10 grand and your dividend is $8,000 this year, well, then you'd only be on the hook for the rest of that $2,000, right? 10 minus 8 is 2. So you'd be only owing what's left. On the other hand, remember, dividends are not guaranteed, so you always have to have some cash in the bank ready to pay that premium if for some reason they don't pay out a dividend. So you can also use your dividends to pay down policy loans. This is something a lot of clients do if they've let their loan principal build up too high. So this is really cool because it's sort of like having someone else pay down your mortgage for you, which is especially good since in that metaphor, you're both the borrower and the mortgage company receiving the payments. In essence, right, as you are banking on yourself. Next, you can let your dividends accumulate with interest at the insurance company. So this is almost like letting the money stay at the insurance company and earn interest like in a CD or a money market account and that sort of thing. And then finally, you can take your dividends just as cash. That's right. You can just simply get your check in the mail for the dividend. Many of our clients take this as their retiree money, as income, which allows the cash value and the death benefit to remain undisturbed and continue to grow the cash value on that guaranteed basis. So imagine you're getting a check in the mail for your dividend. Let's say it's 25 grand or 35 grand or 80 grand that year, just the dividends, depending on the size of your policy, of course. Meanwhile, your cash value is continuing to grow, and you still have your death benefit as well. Again, many times the dividends can be tens of thousands or even $100,000 or even more, depending on the size of your policy. What a great way to spend that money throughout retirement. Now, keep in mind that because we use only non-direct recognition insurance companies, this means that dividends are credited on the gross cash value. So what this means is the dividend will be paid to you and not reduced if there's a loan against your policy. Guys, I just cannot express how powerful this can be, but I'll do my best. I mean, where else can you access your money in your policy and have it still growing for you? This could never happen with stock dividends or a savings account or a 401k or any other instrument in the financial universe. The continuous uninterrupted compound growth of these boring old whole life policies is something that most financial pundits and gurus will just never understand. But maybe you can. That's why I'm doing this podcast today. So at the end of the day, dividends are not guaranteed, but I want them to be dependable. I like working with insurance companies that have paid a dividend without fail for over 100 years. Now, I want to emphasize again how dependable dividend rates are as compared to other places you can put your money. Please see the chart in the show notes below showing another insurance company I like to work with providing a consistent dividend from the year 2004 until 2023. That's almost 20 years of dividends, staying steady even throughout a global financial crisis and a worldwide pandemic. So compare their dividend payouts to the S&P 500, which is on that chart, the 10-year Treasury bill, which is on that chart, and just the overall inflation rate as tracked by the CPI, the Consumer Price Index. Now, we've certainly been through some market dips and turbulence and inflation over the last 20 years, and yet dividend rates are as dependable as you can possibly imagine. Companies with consistent dividends paid not just in the last 5-6 years, but really since 1900, 1860, they prove that they are dependable as a company. So don't be swayed by flashy numbers. Focus on the insurer's track record. As I wrap up this podcast today, here's just a couple of quick action items for you to take control of your financial future with Bank on Yourself designed dividend-paying whole life insurance. Number one, research the dividend stability. If you're looking at insurance companies, look at their dividend, not this year, but their history of dividends. Focus on companies with low standard deviation. This means the dividends didn't fluctuate much over the last 6 years, 10 years, 30 years. You want to ensure dividend reliability, as we discussed. You want to see companies that have been paying dividends steadily since 1905. Number two, prioritize the guaranteed cake over the dividend icing. When you're looking at policies, focus on the guarantees. Look at the minimum cash value, growth, and death benefit too. Buy a whole life policy for what it will do, not what it might do. Rather than just dividend rates, look at the guarantees. This will provide for you a safety net, especially during economic downturns. And then finally, think about your dividend options. Look at resources like the bankonyourself.com's 7 Reasons Whole Life Insurance and Bank on Yourself Makes Sense. You can find that article at bankonyourself.com. Or you can think about all the different dividend options that you can put your money to work in to reinvest as paid-up additions, paying down premiums, taking cash as a check in the mail, paying off policy loans. Just tailor it to your own personal goals. Guys, take these steps to make some informed decisions, and I hope to see you as we climb the mountain Or in this situation, eat the cupcake with a ton of delicious icing. Thank you for tuning in to this week's episode of Not Your Average Financial Podcast, helping you think and live differently with your money, your dividends, and your future.